Most global stock indices showed little change in the month of November, but that doesn't tell the whole story. On a day-to-day basis, market volatility was out in force, particularly for technology stocks. At its low point, the Nasdaq had fallen roughly 8% from its recent peak, with substantial declines occurring for members of the Magnificent Seven. The question of a market bubble or not is making its rounds as investors draw more frequent comparisons to the dot-com era. However, hyperscalers such as Microsoft, Amazon, Nvidia, and Alphabet are carrying hordes of surplus cash, which marks a key difference from the doomed internet-based companies at the turn of the century. While a staggering amount of capital has been funneled into the build-out of AI infrastructure, the pace is bound to cool off eventually. In any rational business model, these investments will need to be eclipsed by the revenues they generate. As capital expenditures climb, however, so do the thresholds for clearing profits. The path to profitability has become the leading question for investors today. The concept of circular financing, where business deals blur the lines between the customer, supplier, and partner, has not provided any additional clarity. Nvidia, for example, has made substantial investments into OpenAI in exchange for a commitment to buy their semiconductor chips. This vendor financing can distort sales and perceived demand, inflating both on paper. Investors have also been reassessing the outlook for interest rate reductions, further contributing to recent volatility. Fed Chair Powell triggered a sell-off in early November after warning that December's rate cut was not a foregone conclusion, and far from it. He also indicated that committee members were divided, some showing concern over labor market conditions, while others viewed inflation fighting as a priority. The best path forward in terms of monetary policy is rarely clear, and recent circumstances have not helped. The longest government shutdown in history limited access to key information, complicating matters further. Toward the end of the month, however, equities rebounded as interest rate expectations suddenly reversed course. The probability of a December cut leapt to more than 80% after dovish remarks from Fed governors and mixed economic data. Given their influence, the Federal Reserve treads lightly when it comes to shocking investors. This may lead to them following through with a modest reduction in their upcoming year-end meeting. If they don't, another sell-off event shouldn't come as a surprise. Canada's stock market bucked the trend and carried its momentum into November. With gold nearly doubling in price over the past 2 years, the precious metals sector continues to be a key driver for Canadian markets. The shiny ore is an intriguing commodity, as price movements typically reflect investor sentiment rather than the standard supply-demand curve. Spot prices have surged in response to several global conflicts, trade disruptions, concerns over the US dollar's reliability, and even the potential bursting of an AI bubble. Retail investors have been piling into mining stocks and ETFs, while central banks add to their bullion reserves. It's worth noting that gold is often viewed as a safe haven asset, but its price behavior isn't always deserving of that name. The yellow metal's stellar rise could ironically reverse course if circumstances improve. Slowing inflation, conflict resolution, the greenback's return to favor, conditions that traditionally benefit most asset classes, could lead to gold's decline. This negative correlation is a sound reminder of why diversification matters. In our view, gold mining stocks serve as a hedge and mitigate portfolio risk. But like most trends, investors need to monitor their exposure, avoid portfolio drift, and take profits along the way. Canada also avoided a potential shock as Prime Minister Carney's first budget edged through the House of Commons, largely thanks to abstain votes from the Conservative and NDP parties. Thankfully, that means two things. First, there won't be an upcoming election. Second, we have a better sense of government fiscal priorities. Infrastructure and nation-building projects are large, time-consuming, and expensive. They are also very easy to announce. The difficult part is buy-in, cooperation, and follow-through. Coming as a refreshing surprise for many, however, was a memorandum of understanding between Alberta and Ottawa to build a pipeline from the oil patch to the BC coast. This could be a positive development, and well-timed too. Investor interest in Canadian politics is abnormally high right now, as deteriorating trade relations with the US have threatened key exports. Overall, there's no shortage of new and existing storylines at play. The most pressing matter is the upcoming Fed decision on December 10th. Thankfully, we'll have our answer soon enough, as well as an impression of where investors will focus their attention next.